Okay, I'm just saying. So there are two people involved in a business, right? When it comes to a parent subsidiary associate relationship, there are people involved in the business, right? That much is
Mm-hmm.
okay. Okay. So
Mm-hmm.
what happens is that there can be transactions between the two entities, right?
Mm-hmm.
I'll just give an example here. Okay. Suppose P is selling goods to S. Okay.
Mm-hmm.
Let's just say it is for the goods actually cost 5,000. Okay.
Mm-hmm.
And P actually sold to S for, let's say, 10,000. Clear?
Mm-hmm.
So what is the profit that P gets here? It's
5,000.
5,000. No doubt. Right?
Mm-hmm.
Okay. Suppose, so S has 10,000 inventory which S bought from P. Right?
Mm-hmm.
Okay. So this entire inventory, if S sold to, sorry, if S sold to the customers, okay,
Mm-hmm.
then there is no scope for unrealized profit. Understood? Okay.
Mm-hmm.
So in order to simply put, unrealized profit are those profits which happens between a parent and a subsidiary. Okay. If the goods are not sold. Understood? Okay. So suppose there is this inventory of 10,000 which S has kept unsold. Then that means the entire 5,000 becomes the URP. Understood?
Mm-hmm.
Okay. I'm telling you again. I'm going to revise it again. Suppose there is a parent company called P and a subsidiary called S. Okay. And the P sold goods to S. Clear? It can be vice versa. Here I'm just taking the example P sold to S. Understood?
Mm-hmm.
So if P sold to S, what happens is that, okay, there is a goods with cost 5,000, which was sold for 10,000, which would create a profit of 5,000. Clear?
Mm-hmm. Mm-hmm.
Okay. And if S has that particular inventory which is kept still unsold, that means it is not sold to is sold to an external customer, then that
Mm-hmm.
particular 5,000 becomes the URP, unrealized profit. Clear? And
Mm-hmm.
when there is unrealized profit, it is necessary that it is taken away or it is removed from the financial statements. Understood? No?
Mm-hmm.
Okay.
Mm-hmm.
And here, accordingly, so we are going to remove it from working note 2. Okay. If subsidiary is the seller. Okay. I
Mm-hmm.
repeat, if subsidiary is the seller, you're going to remove it from net asset of the subsidiary. Understood? So
Mm-hmm.
what happens if parent is the seller, which actually uses a parent thing? Working note 5, right? Group retained earnings. Understood? So if
Mm-hmm.
parent is the seller, you're going to remove it from working note 5. Understood?
Mm-hmm.
Understood? No?
Mm-hmm.
Okay, I'm repeating it again. If subsidiary is the seller, you're going to remove it from working note 2. Clear? Clear?
Mm-hmm.
If parent is the seller, you're going to remove it from working note 5. Understood?
Mm-hmm.
Okay. Now, so what is the logic behind this adjustment? The logic is simply that you're going to take it off from the retained earnings of group subsidiary, that is working note 5. You're going to debit it. Is it clear? Retained earnings, when it reduces, it gets debited, right? Because it's a group 2 nature. Clear?
Mm-hmm.
And there is an adjustment entry equally applicable towards the inventory. Understood?
Mm-hmm.
So in the workings, if you're going to adjust with working note 2 or working note 5, at the same time in the SOFP, you're going to remove that same amount from the inventories. Understood?
Mm-hmm.
Clear? And hence inventory is credited because it is reduced. Understood?
Mm-hmm.
Okay, no?
Yeah.
Okay. Let's see. Illustration 9. All right.
Mm-hmm.
Very simple. There's no such difficulty if you just follow the rules. Okay.
Mm-hmm.
Okay. Illustration 9. Let's read it. All right. So H has acquired 90 percentage of S. Clear? And the DOA is
Mm-hmm.
1st January 2002. The retained earnings at DOA is 5,000. Okay. And the year end is 31st December 2003. From here, we got the group structure. That is H acquires S. It is 90 percentage. Then NCI
Mm-hmm.
is 10 percentage, right? And the
Mm-hmm.
DOA is 1st January 2002. DOR is 31st December 2003. Clear? So it's been
Mm-hmm.
2 years since acquisition. So it is a full accounting year. There is no time apportionment. That is why we are looking towards the accounting years. Understood? Okay, no?
Mm-hmm.
Okay. Now, they
Yeah.
have given us certain SOFP contents of both the companies, H and S, right? You're going to go towards the last thing and you're going to identify what is being given here. Okay. So S sold goods to S. So it is subsidiary to the parent, right? So when it is subsidiary to the parent, it is adjusted in working note 2. Understood? Clear now? Hello? Can you hear me? Can you hear me? To what extent did you hear Elvira? Hello? Hello? Hello?
Your voice is
Yeah,
like
sorry, sorry. So to
it
what
was
extent?
broken.
Yeah, yeah. To what extent did you hear?
Um, it's when you start to explain, like after H acquires S, and this after that your voice was like cut it. It was not hearable.
From where?
Uh,
You've
yeah,
heard the whole
yes,
structure, right?
yeah. Actually, from this, after you said that 10% is that one, and
Okay,
um,
okay. So I just
DOA.
moved towards the last part of the question, okay? Where they have mentioned S has sold goods to H. Clear? So that means it's a subsidiary to parent transaction, right? So subsidiary is the seller. Okay.
Mm-hmm.
So whatever happens would be adjusted in working note 2. Understood?
Mm-hmm.
Okay. Now, here we need the previous chapter. I think on the 17th chapter or so, we studied about markup and margin, right? So same thing
Mm-hmm.
is used here. Okay, they have given us the transfer price of the goods is 18,000, which includes a markup basis, right? So markup means C is 100. Clear? Okay. So C is
Mm-hmm.
100, P is 50. So together 150 is the selling price. Understood?
Mm-hmm.
Okay. So selling price is 18,000 and that becomes you want to find the profit. So in order to find the profit, you're going to do it as what to find, that is profit 50. What is given as the selling price, that is 150. Okay. Now there is a twist because they have told us only two-third is left unsold. Understood? So you're going to do 2 by 3 as well. Clear?
Mm-hmm.
Understood? No?
Yeah.
Okay. Now they've also given us the current account stood at 22,000. So when there is a phrase called current account, then that means you need to take it off from the current asset and current liability. Understood?
Mm-hmm.
Okay. Now, H group uses fair value method of non-controlling interest, and they have given you the fair value of NCI at the date of acquisition is 4,000. This much is clear.
Mm-hmm.
Now, you're going to start the working note 2. So, in the working note 2, you need net asset of subsidiary, that is DOA and DOR values. So, you're going to go down.
Mm-hmm.
Okay, we have got 5. So, 5 here. Clear? We have got
Mm-hmm.
31 here. So, DOR 31. DOA amount is given here. See, retained earnings of S were 5,000. And ignoring 3 zeros, it becomes 5. Clear?
Mm-hmm.
And the URP, when you calculate as before, it becomes this. And URP is always deducted from current assets. That is in the inventory section. Clear, no?
Mm-hmm.
Okay. Now, you're going to total things down, right? This side total and this side total. Clear, no?
Mm-hmm.
Okay. And when you do that, you get the PAR. Understood?
Mm-hmm.
Okay, no?
Yeah.
Okay. After getting the PAR, you're going to split it between the parent and the subsidiary. Okay, so here it is 22 into 90 percentage. Okay, and
Mm-hmm.
here it is
10%.
22 into 10 percentage. Clear?
Mm-hmm.
Okay, now the current accounts of 22 is deducted from receivables and payables. Understood?
Mm-hmm.
So that is what they asked. Calculate unrealized profit and show how the current accounts stands. Understood?
Mm-hmm.
Okay.
The
Now,
NCI is 22% for 10, right? Above.
yes,
Here, above NCA,
yeah. Now
there's,
there is the next working would be of non-controlling, sorry, goodwill, and then you have the fair value of NCI at DOR, and then you have the group retained earnings. Five
I
working.
mean, there's like 22 multiply 10%, right? Not
Yeah,
2.
yeah. NCI. Oh, sorry, sorry. It's 22. Clear? Typing mistake. Okay, no?
Mm-hmm. Mm-hmm.
Okay. Now we are going to move on to mid-year acquisition. So it's not that difficult. Mid-year acquisition simply means that the acquisition happened not just in 1 year, but in the middle of the year. Clear? So it can be from 3 months to 5 months or 9 months, etc. Understood?
Mm-hmm.
Okay. So here in this question, you have got on 1st May 2007, that is the DOA is 1st May. Okay.
Mm-hmm.
But DOR is 30th December 2007. So how many months of acquisition? May, June, July,
Right.
August, September, October, November. That is 7 months of acquisition. Understood?
Mm-hmm.
So here, DOA is this much. Can you see the screen?
Mm-hmm.
DOR is here. Okay.
Mm-hmm.
And the acquisition happened for 60 percentage, which is given here. Okay. So K acquired as 60 percentage. So NCI becomes 40 percentage. Understood?
Mm-hmm.
Okay. So working note 1 is done. The difference is it is 7 months. Clear, no?
Mm-hmm.
Now the second working is of net asset at subsidiary, net asset of subsidiary. Okay. Listen to me carefully. So we're going to move on to the equity section and we're going to take this one for DOA and DOR and this one for DOR. Clear?
Mm-hmm.
Now the problem is you need the DOA retained earnings, right?
Mm-hmm.
Okay. Let's see if something is given here. See, mm, they've told us S earned profit after tax of 9,000 in the year ended 30th November 2007. Okay.
Mm-hmm.
So if it is 30th November 2007, then that means it is the retained earnings of last year. Clear?
Mm-hmm.
Understood?
Mm-hmm.
So here, sorry, sorry. That is, they have given the profit for the year, this year. Clear?
Mm-hmm.
and we need last year retained earnings, right?
Mm-hmm.
Okay, so every year what we do is we're going to add our profits to the retained earnings, right?
Mm-hmm.
So this 69,000 is actually 60,000 plus 9,000 profit this year. That much is clear.
Mm-hmm.
Okay,
Mm-hmm.
so how do you take the date to date of acquisition retained earnings? You're just going to deduct the 7 months profit from the DOR retained earnings. Understood?
Mm-hmm.
Clear now? I'm repeating it again. So you have been given the retained earnings of DOR, right? That is in the end of the year, it is 69,000. Clear? So every year, what we do is we're going to add the tax or the profit after tax for the current year towards the retained earnings, right?
Mm-hmm.
So this particular 69,000 actually includes the 9,000. Understood?
Mm-hmm.
Okay. So we need to reverse it back to DOA, that is date of acquisition. And we already know it's been 7 months since the acquisition, right?
Mm-hmm.
So what we do is we're going to remove the 7 months profit from the retained earnings in order to find the DOA retained earnings. Understood?
Mm-hmm. Mm-hmm.
Okay. So 69,000 minus 9,000 into 7 by 12. Understood? No?
Mm-hmm.
Okay. So when we do that, we got the retained earnings. We're going to total things together and we're going to find the difference, that is PAR. Okay. For your
Mm-hmm.
reference, I have given you how to calculate the amount here. Understood?
Mm-hmm.
It can be both ways. If closing retained earnings is given, you can deduct the consolidation period profit from there. Understood?
Mm-hmm.
If there is opening retained earnings given, you can add the time that is apportioned to the opening retained earnings. Understood? To reach the closing retained earnings. Okay, no?
Mm-hmm.
Okay. Now both the difference are being taken. The PAR is 5250. Okay. And then the same story. You're going to split between the 60-40 percentage. Understood?
Mm-hmm.
Okay. Now working note 3 Elvira. That is goodwill. Okay. For that,
Mm-hmm.
you need to know how much you paid for the company, right? Let's see. Let's see if anything is given here. If it is not given, you're going to go and find through the investments category. Clear, no?
Mm-hmm.
Okay, let's see. Let's see if something is given. Hmm. Okay. So they have already clearly told you they have paid 76,000 for the shares. Clear?
Mm-hmm.
So fair value of purchase consideration is 76,000. Okay. And
Mm-hmm.
in the end, they have given at the date of acquisition, the fair value of NCI is how much? 50,000. So you're going to add it. Okay. So logically explaining, these two are the company's whole value. Clear? What you have got. Okay. Now
Mm-hmm.
you're going to deduct the net asset at DOA, which is there in the working note 2. Okay.
Mm-hmm.
And after that, whatever you get is the goodwill. Clear? No?
Mm-hmm.
Now we need NCI at DOR. You're going to take the DOA NCI at DOA, which is clearly given here. And to that, you're going to add share in PAR, which you have calculated in working note 2. Understood? And you get the DOR NCI. Clear?
Mm-hmm.
Now, the fifth working is group retained earnings. You're going to take the parent retained earnings from the question, that is 189,000. You're going to add the working note 2, right?
Mm-hmm.
And then see, the twist is there. At 30th November 2007, what happened? Inventory of S is the subsidiary, purchased
Mm-hmm.
at cost from 8,000 from K at cost plus 25 percentage. Cost plus 25 percentage means it's a markup. Okay.
Mm-hmm.
So they have clearly told you S has bought goods from K, right? So it is a parent seller. Understood?
Mm-hmm.
And they have also told you the goods has not been sold. None of the goods is sold. Clear, no?
Mm-hmm.
Understood?
Mm-hmm.
Okay. So you're going to calculate how much is the value. I'm just gonna mention it here since you can brush up as well. Okay, it is a markup basis. So C, we know C plus P equal to what? S, right?
Mm-hmm.
Okay, so cost is 100 for markup and the percentage is given 25, so 125. Clear, no?
Mm-hmm.
Understood?
Yeah.
Okay. Now what you need to find? You need to find the URP. So in order to find the URP, how do you calculate this? You're going to take 8,000, which they have told you, okay, into, you need the URP, that is profit, divided by what is given as 125. Understood, no?
Mm-hmm.
Clear, Elvira?
Yeah.
So always and always the equation that I've told you, that I've taught you should be there in your mind. Okay.
Mm-hmm.
So you get the group retained earnings as such. Clear? Now. Okay. So the working is clearly given here in working notes. It's all right. Okay.
Mm-hmm.
Now we're going to prepare the SOFP. So for SOFP, you're going to add them together. Okay. Now, from the investment, you must understand you can't take the 98,000 because 98,000 also includes investment from S. Understood?
Mm-hmm.
So you have to remove it. So you are going to remove the 76,000. Clear, no?
Mm-hmm.
Now the goodwill you get from working note 3, the current asset, everything is same. Current asset, you're going to add everything together, but you're going to remove the URP. Understood, no?
Mm-hmm.
And receivables, they are not, they have not mentioned any current assets in the receivable, so you have nothing to remove from both of them. Clear?
Mm-hmm.
And the bank also, uh, it is there for K, but it is not there for S. Clear?
Mm-hmm.
Now, moving on to the equity side, you're going to take it as if K acquired whole of S, so it is a K company. So share capital also belongs to K company, that is 50,000. Clear?
Mm-hmm.
Retained earnings is from working note 5. NCI is from working note 4. And the current liability is given there. You're going to take both of them together. Clear? And the
Mm-hmm.
total is here. And the totals are tallying. Understood?
Mm-hmm.
Clear, no?
Yeah.
Okay. Now we're going to move on to the next chapter. We're done. Rest of the others are homework for you. When you do, if you have doubts, you can ask me, all right?
Mm-hmm.
So also in order to tell you the context of the exam, in the exam, it would be like that of the test you understanding 6. Clear? See,
Mm-hmm.
they have given you the whole SOFP and they have broken down things. Here, they have asked you about the goodwill, follow the same steps. Here, they have asked you a theory question. Here also a theory question. Clear, no?
Mm-hmm.
Okay. So that chapter is done. Moving on to the last chapter. So till now, what we have, just a moment, Edward, just a moment.
Mm-hmm.
Okay, so in the previous chapters, we have dealt with SOFP, right? So this chapter is entirely dedicated to SOPL, right? So how you can prepare the SOPL of consolidated FS as well as of that of the associates and stuffs. Clear?
Mm-hmm.
Okay. So SOPL is simple. Okay, what you do is you're going to calculate all the normal things that happens in the SOPL. Okay, literally you're going to add everything together. Clear?
Mm-hmm.
Okay. If it is a full year acquisition, full year means it is 1 year acquisition. Understood?
Uh-huh.
And also for this, there is no five-step things that you need to follow. You just need to know how the SOPL is consolidated. That's all. Clear?
Mm-hmm.
We'll understand with the example and come back here. Okay?
Mm-hmm.
Illustration one, you need to consolidate this thing. So P and S are the parent and subsidiary. P acquired 75% of S. Clear? And it
Mm-hmm.
happened several years ago. That means there is no mid-year acquisition. Understood? The
Mm-hmm.
year end is 31st August 2004. You have been given the SOPL of P and S. Clear?
Mm-hmm.
So what you do is you're going to add everything together. Clear?
Mm-hmm.
1200 plus 400, 1080 plus 360. And then you're going to find the gross profit. Clear? And then the administrative expenses would be added together and PBT is found. Clear? Tax
Mm-hmm.
is added together and PAT is found. Clear?
Mm-hmm.
Up until this, it is simple. Okay.
Mm-hmm.
Next is you have to split the PAT between the parent and NCI. Clear?
Mm-hmm.
Okay. But there is a twist here. What you do is you're going to find the NCI profit first and then calculate the parent. Clear?
Mm-hmm.
So how do you find the NCI profit? You take the S. That is, you take the subsidiary part of the profit here. Clear? That is 4.
Mm-hmm.
Into NCI percentage, 25 percentage, that is 1. Clear?
Mm-hmm.
And then you're going to take the balancing figure. That is from the profit of the whole company. You're going to deduct this 1 in order to find the parent profit. Clear? Simple.
Mm-hmm.
Understood? No?
Mm-hmm.
Okay. Now
What you
moving
call
on.
it? The PAT, like abbreviation?
Profit after tax
Mm.
or profit for the year simply. Okay.
Mm-hmm.
Now moving on. So what happens if there is there is URP here. You have studied about URP, right?
Mm-hmm.
So if there is URP or there is intra-group trading, what you do? I'll just explain it with the example, same example that we have studied. Okay. P sells S. It doesn't matter who sells whom. In P&L, everything is same. Okay.
Mm-hmm.
So P sells S. Um, let's say the goods cost 7,000 and P sold it for 10,000. Clear?
Mm-hmm.
Okay. So the sales is how much? The sale happened for how much? 10,000, right? Intra-group sales. Clear? Selling price is 10,000. Clear?
Mm-hmm.
So that is
Mm-hmm.
called IGS. Okay. That is 10,000. Clear? Now,
Mm-hmm.
what is the URP here? If there is, suppose S hasn't sold anything of what have been bought, then that
10,000.
means 3,000 becomes the URP. Clear?
Mm-hmm.
Okay. All goods unsold. Understood?
Mm-hmm.
Okay. So how do you adjust this? So in consolidated SOPL, listen to me carefully. You're going to remove this IGS from the revenue and from the cost of sales. Clear?
Mm-hmm.
So IGS is removed from the revenue, okay, and from cost of sales. Understood? No?
Mm-hmm.
So what happens to the URP? Okay, we'll do it with an example. That is illustration 2. Okay, no?
Mm-hmm.
Okay. Illustration 2. So we have on 1st January 2009, P acquired how much? 60% of S. The SOPL is given here. And at the end, they have told you the good priced at 42,000. So 42,000 is the sales. Clear?
Mm-hmm.
And these goods had a cost of 28,000. Okay.
Mm-hmm.
On December 31st, 2009, what happened? Half of the goods were unsold. That means the URP is just half of the profit. Clear, no?
Mm-hmm.
So revenue, what you do is, so for revenue, what you do is you took the 630 plus 260 minus the IGS. See?
Mm-hmm.
So for the cost of sales as well, you're going to just do the same. Okay. Here you have took the 210 plus 105. You remove the 42, right?
Mm-hmm.
Now the twist happens when there is URP. You're going to add the URP to cost of sales. Understood?
Mm-hmm.
Okay. So add URP here. Understood? No?
Mm-hmm.
Simple. Okay. So I'm going to repeat it again for intra-group IGS. Okay.
Mm-hmm.
IGS is deducted from
Revenue
sales and which one? COS.
cost.
Okay. And URP is deducted from where? Sorry, added in where? COS. Clear? No? This is the treatment. That's it. Clear?
Mm-hmm.
And the remaining is as that is there. You're going to add everything together and you're going to reach the final stage. After that, you're going to take the profit for the year, okay, and 40 percentage of it, and the remaining profits, that is 265 minus 26.68, would give you the parent profit for the year. Clear?
Mm-hmm.
Understood? No? Okay. So mid-year acquisition again. So mid-year acquisition, it's simply the same. Okay. The difference is that for all the S contents, you're going to time a portion. That's all. Understood?
Mm-hmm.
All the S contents, you're going to time a portion it. Okay, that's the only difference. Clear?
Mm-hmm.
Okay. I'm just going to read this off. The following statement of profit and loss have produced by P and S for the year ended 31st March 2009. Okay. And here they have given you on 1st December 2009, P acquired 75 percentage, right? So
Mm-hmm.
acquisition happened on December. Clear? So tell
Mm-hmm.
me how many months of acquisition? December, January, February,
Yeah.
yeah, and
Mm-hmm.
March. So 4
Four.
months, right? So what you're going to basically do is you're going to take all the amount and into 4 by 12. Clear, no? Just a
Mm-hmm.
moment, Elvira. Just a moment. Okay. So what you're going to do is I'll just write it here. Okay. So you're going to take 151 800 plus plus
108,850.
yeah plus 108850 into 4 by 12. Clear?
Mm-hmm.
So every amounts would be taken like that. Okay,
Mm-hmm.
including when you find the NCI profit. Clear? No?
Mm-hmm.
Okay, and that's it. We have done. Okay, this is just for knowledge purpose. That is what happens when you acquire an associate. It would be between 20 to 50 percentage. Clear?
Mm-hmm.
And how do you calculate the amount of associate? You're going to take the purchase consideration. Okay. To it,
Mm-hmm.
you're going to add the post acquisition profit. That means after acquisition, how much profits you get from associate is added. Okay.
Mm-hmm.
And if there is any URP involved, you're going to remove the parent URP from the equity method. That's all. And then you reach the amount. Okay. The maximum possible question that you could be asked is what is the value of associate? That's it. Clear?
Mm-hmm.
Understood? And also a theory question could also be asked, which is the method by which you calculate the value. It is called as the equity accounting or equity method. Clear? Okay.
Mm-hmm.
And that's it. Our chapters are over. Okay.
Yeah.